Please confirm to me in chat that you can hear me fine, and we start our next webinar right away. Hello, can you hear me fine? Okay then. So today we present the fourth and the final part of naked trading principles, which is called historical levels in intraday trading. This time we will have a look on a very basic yet powerful as well concept of static lines and its implementation from historical point of view. Okay, at least Mike has responded. Thanks to you, Mike. Last but not least, a few words about me. I'm trading since 2008 and have recently focused on so-called naked trading or trading without technical indicators. This is why I'm putting so much attention on different tools that can provide very efficient insights on market trading without using indicators. This method includes as well static lines that we will examine during today's session. As I see, some of you have also got some experience in individual trading. Then you probably know that any winning trading strategy won't be working sustainably without a proven and trustful partner. This is important to be educated not only in trading skills but in trading conditions as well. So please have a look on features offered by Tickmill and displayed on the current slide. If your broker doesn't provide you with such essentials as competitive spreads, segregated funds, and lack of free quotes, you'd better think of it once again. It's high time to turn to historical lines. You may have noticed that studies of financial markets can get complex and sophisticated, but in many different strategies, it starts just simple as the line. Today we get back to the concept of line and dig deeper in one of its certain types. I mean historical static lines. In this webinar, we focus on such part of line tools as historical static lines. Just to remind you that basic lines are distracted into static and dynamic. And going further, static lines can be selected into immediate and historical lines. So let's start with the immediate type of lines. A little agenda. As a first step, we know how to use immediate static lines in the trading. Then we set up different short-term historical static lines. Finally, we review long-term historical static lines and see what are the difference between two of them. And finally, we confirm trade entries using lines as well. So displayed here is a technical chart of euro-dollar, probably the most popular and well-known trading instrument for all of you. Pictured here is a intraday 15 minutes time frame, and if you look at the upper side of the picture, you may note a horizontal static line. It has the value of 1.0968. And this is what we call an immediate static line. It is designed very simple. They are regularly produced and can be interpreted as recent extreme levels. In this current example, you may notice that the peak of 1.0968 is corresponding to an intraday high of Tuesday of yesterday trading, and this line worked effectively as a static resistance during today's during the start of today's European session around 6:30 a.m. The price has stopped just 2 pips below previous static lines at 1.0966, and this is basically the description of immediate line. What happens when you save immediate static line and it works again as active support or resistance level? That means that you probably face short-term historical line. Let's get back just to the previous picture, and here is a good example of what it could be. In the beginning of the chart, please pay attention to July 20th. There is a local double peak at the moment of 1.0865. The price has worked fine 2 times and then have got some short-term resistance during the climb, during the move towards upside for Eurodollar. And as you may see now, the price is declining from its current rate of 1.09 back into the direction of 1.0865. So if the assumption is correct, probably already during today's American session, you'll be able to see how this level works again as a short-term static support, as a static support level. The major difference between the previous two is that it's not immediate anymore. It is safe from Monday, which is not so long ago, but as you may see, they appear regularly and they can become actual for you several times as well. So short-term historical levels appear as significant static levels in flat periods or on intraday charts. And the important thing about them is that they are difficult to recognize after the current period has passed. It's between different trading platforms, but usually you can see only certain amount of candles or bars on a certain time frame. It could be 1000 bars, for example. In terms of 15-minute chart, it's about 7 to 10 days, which is not so much. So it's likely that already next week, if you're starting analyzing the charts from the scratch, you probably won't see such level as a static line anymore. This is why it is important to find it just in time and then save it for further studies. The other difficulty about short-term historical lines is that they are not easily recognized on bigger time frames. Let's get to live study. Let's find out and compare how easy is finding static lines for euro dollar. As the first example, we take 1.0865, and as the other, we take 1.1090. Let me turn now to live 4-hour time frame. Please let me know if you see it fine. You should be able to watch what's happening on the screen. Pictured here is a live chart of 4-hour euro dollar chart. Is it fine? Okay. So the first level to watch is 1.0865. Let me mark it with a bright color and a thick line. And the other study is 190. Let me do the same. So we start with the lower line. I would say that this is a good example of a line that started as a short term, but then has evolved and generated a more stable long-term static support signal. It's not really easy to recognize the importance of the line during March because the price has been going below and above it many times without producing some efficient signal around this level. But the moment it starts working as an important line is marked here with the red arrow. This is the last week of month of May when this static line has provided a stable support which was multiple times, I would say six times, and we have seen just one fake spike below it as a long shadow. So this is basically good performance for the static line. Again, it appeared as a valid static support level just recently on 16th of July. We have seen that price has developed a little bit more below this level, the current low of 1.0803. But eventually, just in the course of few days, it has returned to the upside above this level, and currently this static line is working as an actual and valid support level for euro dollar pair as well. So if you're in euro dollar at the moment, I would suggest you to pay attention to 1.0688 level as a probable static support that can stop a short-term decline of the pair. Just in case, to remind you that I'm following closely the chat section in our webinar. So if you're having any issues with the sound, or better, any questions regarding the topic of this webinar, I would be very happy to get some questions for you and answer them if possible. So we are continuing examining the examples of short-term trend lines, and now let's move to the upper line of 1.1090. This is the other example that shows us that sometimes short-term lines are tricky to be recognized. We can see that in the period of April and May, I will zoom it in for understanding. This has worked. This price level has worked as a static support line multiple times, but euro dollar has experienced multiple spikes below it. Spikes are marked on Japanese candlesticks as narrow lines, or also known as shadows. So we see two spikes on 29th and 30th of April. Then we see that the candles are closed on 5th of May, just right at the level of 1.1090. And this point of in the beginning of May could be the right entry point to understand that this is a valid short-term level. But when you see overall on this price chart, you probably notice that it's not that obvious. If you would be working only with long-term charts, you would probably pay attention to a different one. I would say you could put your static line at about 1.1062, which in my opinion is not that valid because it covers most spikes, and spikes are of lower priority in comparison to closing levels. So my suggestion is to move the level backwards to the upside, 1.1090, and let's see. It's not that clear that the euro dollar is going to retest such value close to 1 point level at the current moment of developing downside. But in some future trading, this level could be valid to you as well. Back to the presentation. I hope that this live studies was clear for you to understand, and yeah, this is a good argument for the point that there is a certain difficulty about short-term historical levels that are not easily recognized on bigger time frames. Now let's move to long-term static levels. Once again, we start with some example, just to give you a clear understanding of what does it mean at the beginning. You can see the chart of Australian dollar to United States dollar, and the selected time frame is weekly. There are two static lines depicting the time frame, and I suggest to start with the lower one. Its clear value is 0.7260. Let's see how it is recognized on a bigger time frames. This is a weekly time frame. Historically, we go back to summertime of year 2004, and since then we can see that Australian has posted several clear stop levels or reversal points back in 2006, 2005, 2006, and did it for 3 times. Once again, price has returned on the turn of 2009. The price has developed to the upside significantly, but in the current moment, in a course of more than 10 years, the price of Australian to United States dollar is developing back to the level of 0.7260. So as you may see, we work with rather big time frames, and on such point is these historical lines are very easy to be recognized. Let's dig into some theory about long-term historical levels. What I recommend is reviewing them only on big time frames, such as weekly and daily charts, because mainly they are not that visible in intraday charts during your everyday trading. So a useful tool is to copy these numbers, like 0.7260 for Australian to United States dollar, and put them inside your intraday charts as well. So by the time the price is getting closer to the point, you may not remember it historically because it happened 11 years ago. So no wonder you don't remember it. But the chart will give you a nice tip about it. In my opinion, an example of static historical levels in long term is provided to us by British pound to United States dollar instrument. So I turn now to weekly chart of GBP USD as well. As a rule, I ask you to confirm if you can see the updated charts. You probably recognize British pound to States dollar with 4 Solomon lines. So the first point selected is 1.7042. This is a nice example of a really long-term historical level. We set up in between of year 1997 and 1998. The price has produced several spikes above this level, which is a certain signal itself. Big shadows in Japanese candlesticks show that this static level doesn't make the price move forward to the upside and stops it on certain levels. In particular, it was tested in the last days of 1996. Then the price reapproached this level in July 1997. Then the price moved to 1.7040 in November of 1997. One more test of the level, but it was unsuccessful at all in April 1998. Finally, in October 1998, it was breached for just 2 weeks, and on the third week it went below this level, and we were following these signals back 17 years ago that could bring you, well, some 3,200 points, which is not that bad for financial markets. Once the historical level is set up, we follow it from the left to right. Once again, you could remember about this level in October 2003, when this level helped you to find a good retracement point in a bigger upside move. And back to reality. When the British pound has become really costly in between 2003 and 2005, the same static level has provided very nice support, which is basically taken in account of this current value of static line at 170.40. And as you see, it helped us retrace once again. During the financial crisis of 2008, this price level was not that helpful, but still it's possible to see how it interacted with the current prices by that time. In October 2008, during the crash, 1.7040 was the closing point for one of the wicks, which has produced then some retracement. But due to certain fundamental reasons, this retracement was short-lived, and the price went further below. A financial crisis in so-called modern period financial trading, we see that this level has worked very impressive 2 times, in August 2009 and in July 2014, rather precise tops for this financial instrument. Last time it has retraced 1 year ago from it, and it remains valid for further trading as well. If we get through the current resistance lines to the upside and we evolve above 163.10, for example, then it's quite certain that this level will continue bringing us correct examples. Perhaps this example has been a good historical retrospect, but I'm quite sure that you are more interested in how these long-term historical levels can be used in your current trading as well. This is quite clear because such historical perspective is really to follow and examine, but it doesn't add up much to your trading. Luckily, British pound gives us a good example of historical level, which could be currently used as well. And this time I'm at level 152.60. We can zoom out to 5-year scale from the start. You don't need to get really long time ago backwards to find this nice triple bottom between October 2011, January 2012, and May 2012, when this fixed reversal figure has appeared. And the level of 152.60 was playing a significant role during the trading in our current year, 2015. Let me change time frame to daily chart so you can see it more clearly. 1.5260. So first time this static line worked as very nice confirmation for entering sell trade. You may see that in the beginning of March, it was 5th of March exactly, the candle has closed below this level, retraced very nicely, so you can have a nice entry point. And then it developed its downside really intensely. Next time, let me delete Fibonacci line. We are not examining them today. Next time, this level was important in last days of April. On April 27th, the price touches exactly 1.5260. After that, it retraces next day 110 pips below. So quite a good downside move of 110 pips. And after that, it produces a clear close above this level. Similar happens in the NMA again. The price during downside touches 1.5260 exactly and produces some 85 pips move to the upside. This is one of the examples how long-term historical levels can be used in your intraday trading. If you're open in the direction of trend, you can probably use this line as a target point, and then you will have an opportunity to re-enter in the same direction of the market, but winning this 80 or 110 pips retracement, which has a significant value for your account. Last time, this level worked on 9th of June, when after some hesitation mode, British pound has decided to move up finally, and before going to the upside, the instrument has given last kiss to 1.5260, and then has produced almost unstoppable rally to the upside, posting 640 pips rally from the start. Next line to watch, again on British pound to United States dollar, is 1.5810. Zooming out. So just to make sure you understand the logics correctly, we get back some 15 years ago again, and we see that the selected instrument has been playing with 1.5810 price for a few times in March of 1997 and in August 1997 it was used 2 times as a static support level. This happened again later in April 1999. After that, the static historical level has taken some 3-year vacation, after which it continued being used as the first static resistance during its rally in June 2002. This was the moment when the price has stopped and produced an impressive 600 pips retracement. This move may not look significant, but remember that this is a high time frame of weekly, and 600 pips is a significant difference for your trading account, definitely. Later in July and August of year 2003, this level worked again as support 2 times. It was breached for a short period, but then it has retraced back above it and thus posted a signal for some buy option. That is the short roundup to 1.58. We returned back to this level in 2009 when it works as some temporary support level for a flat period between June 2009, September, and December 2009. It has produced several reversal points in July 2011. Sorry. July 2011 and November 2012. During late months of 2013, the level has worked as some of magnetic fields, but honestly speaking, it was not that precise. Despite the distance between the line and spikes of prices is not that big. Actually, it's above 40 pips distance, and it can be considered as a precise point for sure. Different situation appeared just recently this year when the price has used this historical level, which for the moment started 17 years ago, as a very precise point for targeting of buy stops. In May of 2015, the price has technically touched a historical level of 1.5010 and produced, guess what? Again, a 600 pip reversal. Next time, this level played actual just last month in the middle of June. And this example is a bit more tricky. As you can see, the price has overcome the historical level and has gone above it. So this level, this historical level, was not that good in producing correct exit or entry point, but still it could have been used as a useful confirmation for further trades. Let me explain you shortly. After the price was broken above historical levels, just next week it retraced intensely and very significantly below this level. So it was the first indication that the downside is about to continue. And on the next level of the last week, on the last days of June, before falling to a recent low of 153.25, British pound has retraced back to 1.5810, which this time could have been used as the right entry point for selling trade. So, given speaking about accuracy of such long-term historical levels, we can clearly see that just in 2 recent months, this price has given us 3 correct entry points and 1 wrong entry point. So if you just imagine that that you open an account to trade solely historical level of 1.5810, it would give you a 3 to 1 point ratio. Quite professional for a basic static line, don't you think about it? So before we continue, please let me know if you have some specific interest in any other currency pair or trading instrument, so we can load its live chart and try to examine some long-term historical points to help you specifically to set up your trading charts in compliance with the tool we are describing today. So if you have any exact suggestions what this instrument or currency pair could be, please share it with me in chat and we'll take care of it. So by now, going back to some theory and further studies. As indicators for short and long-term historical levels are commonly used extreme levels. Extreme levels, in other words, mean local tops and bottom, which are very easy to find if you just look at your chart. It's usually marked with a significant spike, which differs a lot between either other neighboring prices. But Fibonacci tools may also provide relevant static levels. I will prove it with the example of euro dollar. If you remember, we have been speaking about Fibonacci tools last time. And this is the way how it works. So the example not be that precise. Still, you just need to put your historical trend static line of 1.0865 a bit higher to 1.8080, and you can see that this static level is easily derived from a significant 61.8 correction level point to the recent upside move that was registered throughout May of current year between 1.0520 and 1.1446. And as you may notice, this static level is working quite fine as static support level for current euro-dollar traders. Seems we have got at least one significant static level to watch for our intraday trading right after we end this session. So, and one more idea. My suggestion is that you look for additional confirmation. That means if historical static level is confirmed with intraday dynamic line, that improves its reliability. It's a combination of strengths of different tools. Like first, you set up a current specific level at a certain static point, and then you see that the dynamic line is approaching the same price value in a certain time period. So this could work as a good confirmation for your trades. In case you have got no further questions by now, we move to conclusion. Historical static lines have higher priority in comparison to immediate ones, as they provide more reliable levels and signals. Secondly, Long-term static lines are important to remember in intraday trading. They are usually visible only on bigger time frames, and this is important to include them in intraday charts as well. Finally, short-term static lines work best with confirmation from dynamic levels. When you see a confirmation, you're more trustworthy about this tool. Once you test these tools on demo account, it's high time to check its performance live. That is the right time when Tickmill can help you. Our broker offers you a classic account where you do not have to deposit as much and where the trading conditions are nevertheless great. With Tickmill's classic account, you can enjoy trading with quite a low spread that starts at 1.2 pips for Euro USD pair. In addition to this, there are absolutely no commissions attached to this account. This is quite an important feature for the beginners, as it lets them to focus on primarily on the market conditions without spending time on calculating the profitability due to the commissions. This session is coming to an end. I want to thank everyone who has joined us for Naked Trading Principles series that have been conducted with the support of a Tickmill broker throughout July. And I want to use this time to announce our next session that would be focusing on mastering Fibonacci levels. If you are able to participate in our following webinar that takes time next Wednesday, July 29th, 12 GMT as well, you would be able to review together with us the Fibonacci principles and learn how to set up more sophisticated patterns in comparison to Fibonacci corrections, such as extensions and significant time periods. As always, we will apply the tools we are speaking about on live trading charts, so you can not only see what are the theoretical waves of examining the markets, but also look how it improves your understanding of the market live. I hope you enjoyed this session. It was useful for you as well. And I hope to see you next time. Thank you.